Right. So what we have here is this idea of the revaluation model here. And so first thing is that the intangible asset may be revalued to a carrying amount of fair value, just like we would with IAS 16. Nothing special. We're sort of arguing that you can. You can. I mean, of course, the difference, of course, with IAS 16 is we're dealing with property and there is a very active market and we know what's going on. Because I guess with revaluation, you need to know that what are you revaluing this thing to. So typically, it's just seeing if there's an active market. That's the point. But let's expand this. Let's carry on with this. So typically, the system is the same. You revalue and then you depreciate, revalue, depreciate as you go along. A carrying amount of fair value less subsequent amortization and impairment losses. So again, fair value should be determined by reference to an active market, right? So an active market is a market in which transactions happen with sufficient frequency, which is the interesting bit here, to provide pricing information on an ongoing basis. And IAS 38 states that active markets for intangibles are rare. This is the issue here. So the standard argues that, listen, this is rare, and specifically prohibits the revaluation of, of patents, brand names, trademarks, and publishing rights. So we have this specific prohibiting of these assets. So generally, when we have an active market, it means that we have similar looking items, but these brands aren't identical. These are very different. Willing buyers can normally be found at any time, and prices are available to the public. And we see failure of this with most brands. So most intangible assets have value because they're unique and therefore are unlikely to be homogeneous. So certain licenses may fit this model and could possibly be revalued, but most other intangible assets will not. So generally, so that's the first thing. So so here you are. You have bought this intangible, and you're thinking, do I stick to the cost model or do I go with a revaluation model? The standard is saying stick to the cost model. It is tricky finding an active market for this item. So in effect, what you are left with is the cost model, and you can't really go with revaluation. That's sort of the key point. So it does specifically just prevent all of those things that we talked about. Now, the next step here is this issue of internally generated intangible assets. So that's just the key point here, is just a no. You can't capitalize that because it's really the issue of separability and measurement. So again, this question of faithful representation is the issue here. You could actually generate you could have a brand internally generated that's bringing in income, probable economic benefit. You have worked on this thing, but there's just the question of objectivity. So until you sell off the business, then that crystallizes it to be fair. Until then, it hasn't done so. So generally, internally generated intangibles cannot be capitalized, as the costs associated with these cannot be separated from the costs associated with the running of the business. So generally, these internally generated like any inherent goodwill. So you think, oh, my reputation has improved as a business. No, you cannot. Any internally generated brands, mastheads, publishing titles, customer lists, absolutely not. Anything internally generated. If you buy a customer list, no problem. You can recognize that if it's purchased. But then, of course, the question becomes about revaluation of that customer list. So you can't do that either. But at least if it's internally generated, we know, no, you can't. You can't do it. Right. And generally, this is, of course, you've been having debates on brands. We've been having debates on brands for a long time with regards to whether or not we should be able to recognize them because they are distinct and you could possibly sell it. But the standard has just literally said, listen, you cannot recognize these brands, as we cannot distinguish clearly from the whole business, if you like, as a whole. Right, and so where brand name is separately acquired, yes, of course, then again you can, of course, recognize as an intangible, non-current, and account for according to the general rules pretty much at cost. And again, you'll be struggling to revalue this because there is if you like, there is no active market for your brand. Right. Let's carry on. So, how should the following intangible assets be treated in financial statements? Well, publishing title, for example, acquired um, as part of a subsidiary company. A license, for example, purchased. These are all intangibles. Also, market a new product. So really, again, like I said, the question is really about, can we measure this reliably? And as long as we can, well, yeah, and I think as long as we can, then you do so. Now, if of course, if it can't, then you probably just recognize it as part of goodwill. So you can see the point here. If you're acquiring a subsidiary, and you cannot, you try, and if you can clearly separate the brand, then recognize that, of course, within you consolidated. But if you can't, you're just paying for it, so it can live within goodwill, and that's perfectly normal. And again, but again, the point is that as long as if you can pay for it, then you're recognizing it at cost. Nothing crazy there. And goodwill. We have discussed goodwill. If you like, in the later chapters, this question of consideration, non-controlling interest, total consideration, less the net assets of the subsidiary, and that extra that you have paid, if you like, is considered to be goodwill. So that's the key point. So we're talking about purchased goodwill, that it is purchased goodwill that we can recognize and we will impair year on year, because goodwill is like one of these, again, forever and ever. There is no life to it per se. You can't say it's going to be for 10 years. No, so year on year you look at it and you decide what you wish to do with it, impairing it. So again, like what we've just said here, fair value. Of course, fair value is important to. Of course, we talk about this already. IFRS 3 and 10 guide us, and we have 13 to guide us to this meaning of fair value, to make sure that the exchange was fair. And this is what we're sort of paying for, the extra. We're paying for something. There's something about the business, right? Above its just net assets, the fair value of the net assets. You're paying extra for something here. Reputation, just the contacts, their sales book, just good management and staff, if you like. So here we are. So internally generated intangibles, we never recognize any of that. We can recognize purchased goodwill, and of course, I think that's the main point here. Without so non-purchased goodwill, they're just I'm just reiterating everything I've talked about before, is known as inherent goodwill. We can't separate it. We do not recognize it in the accounts. And I've kind of discussed this. This really is to do with chapter 17. So I'd actually recommend, definitely teach the later chapters first. So do the chapters on business combinations first before coming here, so that this isn't entirely new for you. So goodwill is defined here as an asset representing well, again, where we can separate that out. It's the extra you have paid. It is possible that you could pay. Imagine an asset is worth 100,000. It is possible that your consideration plus the non-controlling interest could be, I don't know, 80 and here 10. You could be paying 90 for something that's worth 100. The argument here is that look at this again and see, is it really worth 100? It probably means that if you're willing to pay 90, it probably means there's some impairment here. This is just thinking about it, right? Generally, why would you pay? It's a bit odd. So probably the best argument is to work on this. Most arguments I've heard is to take this 100 and look at it again and bring it down to 90, and therefore argue there's no goodwill at all. Just means there's an indication of impairment if you're willing to pay, right, less. But if that is truly the case, then you've made a bargain, and so any gain, this 10 million gain, imagine this is all in millions, is recognized to the income statement as gain on purchase, if you like, of your subsidiary. So again, key point here is that we cannot recognize any non-purchased goodwill. I typically just go through the text, so a lot of that repeats itself. Cool, great. Another 10 minutes covered, and we will finish off with research and development in the final video.